Welcome back to the Deep Dive. It is Sunday, February 22nd, 2026.
Yeah.
And I have to ask, how are your nerves holding up this week?
Oh, I mean, if you're looking at the charts, it's a test of patience right now.
It really is. Like if you've been glued to your screens, refreshing your portfolio app every 10 minutes, you are probably feeling a distinct sense of, well, frustration.
Mm-hmm.
The charts are just chopping sideways. Bitcoin is flirting with resistance but refusing to commit, and Ethereum looks like it needs a strong cup of coffee. Or maybe a nap.
Yeah, it's definitely what you'd call a hurry up and wait kind of market on the surface. We're in that awkward phase where the euphoria of late 2025 feels like a distant memory, but the crash is over.
Right.
And now we're just sitting here. But, and this is a massive but, if you stop staring at the price candles for a second and look underneath the hood, specifically at the regulatory plumbing, this might have been one of the most consequential weeks for the financial system that nobody is actually talking about.
I love that framing. We tend to get so obsessed with the casino aspect of crypto, the price action, the green candles, the red candles.
Exactly.
But you're suggesting the real story is in the boring back-end infrastructure. Like, we have a situation where the U.S. government, specifically the SEC, has quietly removed a huge hurdle for Wall Street to enter the market.
Right. And the market hasn't really reacted yet. That's the paradox. You have sluggish charts, but the operational rails just got greased in a major way.
It's like everyone is complaining the train isn't moving, while the engineers just finished upgrading the tracks to high-speed rail.
That is exactly what's happening.
Okay, so our mission today is to reconcile those two realities. We're going to unpack this plumbing revolution, figure out why Bitcoin is hitting a ceiling at 70K, and look at this strange divergence where Europe is buying while America is selling.
Let's do it.
So let's start with the big news from February 19th. The SEC's Division of Trading and Markets updated their guidance regarding payment stablecoins.
Right. And to understand why this matters, we have to talk about something incredibly dry but incredibly important. Rule 15C301.
Ah, 15C31. Rolls right off the tongue, doesn't it?
It really does.
I can totally see why this didn't make the front page of the tabloids.
Exactly. It's not sexy, but it is the bedrock of Wall Street safety. This is the net capital rule. It basically dictates how much liquid cash a broker-dealer, think of the big trading desks at Goldman Sachs, Morgan Stanley, or even smaller crypto-focused brokers, how much cash they must keep on hand to ensure they don't go bust. It's their safety buffer.
So it's basically the rainy day fund mandated by the government.
Precisely. Now, here's the before picture. Before this update on February 19th, if one of these regulated firms wanted to hold a payment stablecoin, like USDC, on their balance sheet, the regulators applied a 100% haircut.
Let's pause on haircut for a second, because in this context, we aren't talking about a trim at the barber.
No, definitely not.
It's risk management jargon that I think trips people up.
It does. In finance, a haircut is the percentage difference between an asset's market value and the value the regulator actually allows you to count it for.
Okay.
So a 100% haircut means the regulator views the asset as having zero value for your safety requirements.
Zero value. Even if it's a dollar stablecoin fully backed by U.S. Treasuries.
Even then, the regulator was essentially saying, we don't trust this asset class yet. It's too risky. So let's play this out simply. Imagine you are a broker. You want to hold $1 million in USDC to settle trades efficiently on a blockchain over the weekend when regular banks are closed.
Right, the 247 nature of crypto.
Exactly. But because of that 100% haircut, the SEC effectively said that $1 million in stablecoins is too risky, so you need to set aside another $1 million of your own cold hard cash to cover it.
Wow. So practically speaking, you are locking up $2 million of capital just to facilitate $1 million of business.
Yes. It was incredibly capital inefficient. It basically acted as a penalty tax. It made it economically stupid for a broker-dealer to use stablecoins for daily operations.
Because why would you tie up your balance sheet like that when you could just use slow, old-fashioned wire transfers?
Right. It was a massive deterrent for institutional adoption.
And that brings us to the afterstate. What actually changed on February 19th?
The SEC issued a new guidance stating that for qualifying payment stablecoins, the haircut is no longer 100%. It's now roughly 2%.
From 100% down to 2. That's not a tweak, that's a complete reversal.
It is a sea change. A 2% haircut is basically treating stablecoins similar to a money market fund. It signals that the U.S. government is finally admitting that crypto dollars are safe enough to be core financial infrastructure.
That's huge.
The only real requirement is that the broker-dealer has to do their due diligence to ensure the stablecoin is actually backed by cash or treasuries. But once they check that box, the massive penalty is gone.
So, practically speaking, this isn't about letting retail traders buy more meme coins.
No, not at all.
This is about allowing institutions to finally use crypto as the actual rails for moving money.
Precisely. And this is the insight that I think many retail investors miss. We got the ETFs years ago, right?
Yeah.
An ETF allows people to bet on the price of Bitcoin. It's purely speculation. This rule change is different. This allows institutions to operationally use the currency for settlement, for moving collateral, for clearing trades instantly.
It's the difference between betting on a railroad stock and actually being allowed to put a train on the tracks.
That's the perfect analogy. And if you look at the sentiment analysis from some of the deeper discussion threads this week, we specifically pulled a really insightful Reddit thread for this. The smart money gets it.
What are they saying?
They are calling this the boring plumbing that actually moves the needle. It turns stablecoins into core financial infrastructure. And once a bank starts using stablecoins for settlement because it's cheaper and faster, they aren't going back. It's sticky.
It makes sense. It's balance sheet friendly now.
Exactly. It lowers the barrier for institutional adoption way more than an ETF filing ever did.
Okay, so the plumbing is fixed, the pipes are clear, the Wall Street engineers are happy. But if we look at the house itself, the market prices, it looks a little shaky. Let's pivot to the charts. As of February 21st, 2026, Bitcoin is hovering right around $68,162.
We are, and context is everything here. We really have to remember where we came from. We hit that euphoria peak of around $126,100 late in 2025.
The blow-off top.
The absolute blow-off top. Since then, we've had a brutal hangover, sliding all the way down towards $60,000 earlier this month.
So stabilizing at $68,000 is technically a recovery, but it feels, I don't know, fragile. It feels like we're knocking on the door of $70,000 and nobody is answering.
That $70,000 to $71,000 zone is a fortress of resistance right now. It's both psychological, since round numbers always are, and technical. There's a lot of supply sitting there.
People who bought the dip on the way down in 2025 and are just looking to break even and get out.
Exactly. However, the good news is that support at $65,000 is holding firm. We are essentially in a pause and observe phase.
I was reading an analysis on Binance Square that mentioned this sentiment data.
Ah, yes.
The data indicating that retail hype, the Lambo memes, has basically faded entirely. My cab driver isn't asking me about crypto anymore. Usually people think that silence is bad, but you think that's actually bullish.
It is a classic contrarian signal. When your cab driver is asking you about crypto, you sell. That marks the top. When the forums are quiet and people are bored, that's usually where a stable market bottom forms.
So the tourists who showed up for the 2025 rally have left the building.
They're gone. The weak hands are washed out. That leaves the believers, the long-term holders, holding the line. It's a much healthier market structure. You can build a foundation on holders. You cannot build a foundation on hype.
Okay, so Bitcoin is stable-ish. It's boring, but stable. But Ethereum looks like it needs a hug.
It really does.
We are looking at a price near $2,300, and the sentiment feels significantly worse than Bitcoin. What's going on there?
The contrast is pretty stark. The divergence between Bitcoin and Ethereum is widening right now. While Bitcoin is acting like digital gold, a store of value, Ethereum is struggling to define its narrative in this specific part of the cycle.
And the technicals reflect that, right?
Very much so. The technicals are painting a bearish picture. We are seeing indicators like the MACD and the RSI sitting around 34, suggesting that this recent little bounce up to $2,300 is what traders call a dead cat bounce.
Which is such a vivid image. Basically, a temporary recovery in a crashing market that just leads to another drop.
Right, it's a trap. It lures you in thinking the bottom is in, and then the floor falls out again. Also, the shaken money flow is negative.
Break that down for us.
It's just a way of saying that volume is higher on days when the price goes down. Capital is literally flowing out of the asset. The consensus from the analysis we reviewed, specifically looking at the CCN data, is that unless ETH can reclaim $2,450 with significant volume, the path of least resistance remains to the downside.
It's unlikely to hit $3,000 in February then.
Highly unlikely. Institutions are just wary right now. The ghost window for games, that period where an asset moves up with very little resistance, it just hasn't opened for ETH yet. They're watching Bitcoin for direction, but they aren't bidding up ETH.
This stagnation brings us to the bigger question. Why? We have the SEC fixing the plumbing, the tech is better than ever, but prices are stuck.
Yeah.
This brings us to the macro view. We looked at a macro risk memo from Benjamin Cowan for February 2026. He diagnosed the economy with something called late-cycle restrictive digestion.
It sounds like a medical condition you get after a heavy Thanksgiving meal, doesn't it?
It really does. I can't come into work today, I have restrictive digestion.
Boss, I need the day off.
Exactly. But what does it actually mean for the market?
So quantitative tightening, the Fed shrinking its balance sheet, officially ended in December 2025. That theoretically should have been the all-clear signal, but liquidity is still tight because real yields are high.
Real yields meaning interest rates adjusted for inflation.
Exactly. Even though inflation has cooled down, interest rates are still relatively high compared to that inflation. That means money is expensive in real terms.
Right.
So we are in this digestion period where the market knows the tightening is over, but it's waiting for the Fed to actually make money cheap again.
And that's the catalyst. Interest rates. We had 3 rate cuts in 2025. The market seems desperate to know if we are getting any in early 2026.
That is the multi-trillion-dollar question. The prediction markets, like Polymarket, are showing very low confidence right now. They correctly bet against a January cut, and now they are showing rising confidence for March or April, but it's still divided.
And this connects directly back to that Lambo crowd we mentioned earlier. Retail investors generally borrow money or use margin to speculate.
Correct. Retail thrives on cheap liquidity. When you can borrow at 2% to buy an asset yielding 10%, you do it. That's a no-brainer. But when borrowing costs 6 or 7%, the math just doesn't work.
Until the Fed eases aggressively, we're basically in a waiting game.
Yes. We are just trading coins between existing holders. There is no new ocean of retail cash flooding in.
And the labor market is playing a weird role here too. We aren't seeing mass layoffs, which prevents a full crash, but it contributes to this waiting game.
It's called a diffusion of weakness. It's a slow bleed rather than a sudden wound.
Like a slow leak in a tire.
Exactly. Layoffs aren't spiking, so there's no panic, but hiring has gone defensive. Companies aren't firing, but they certainly aren't hiring either.
It creates a totally stagnant environment.
There isn't enough fear to force the Fed to panic cut rates, but there isn't enough growth to ignite a rally.
So we're stuck in the middle. Not hot enough to rally, not cold enough to crash. This stagnation has created a fascinating geographic split, though. I want to talk about the tale of two markets.
Yes, the fund flows.
We looked at the CoinShares report for mid-February, specifically February 13th through the 16th.
This was the most fascinating data point of the week for me. Globally, we saw a 4th consecutive week of outflows, a total of $173 million leaving crypto funds.
Which, on the surface, sounds really bad.
It does, but when you peel back the layers, it's basically a regional civil war.
The U.S. is dumping.
Massive selling in the USA. We're talking $403 million in outflows. American investors are spooked, or they're taking profits, or they're just tired of waiting for the Fed. They are hitting the sell button.
But Europe and Canada?
They are buying. They saw $230 million in inflows. Germany and Switzerland are accumulating aggressively right now.
What is the psychology there? Why does a German investor see value at $68,000 while an American investor sees a reason to sell?
It speaks to a difference in time horizons. U.S. investors are hypersensitive to the Federal Reserve and the political theater in Washington. They watch the daily news cycle.
Right, the immediate gratification.
European investors seem to be taking a longer-term value approach. They see the dip from the 126K high as a massive discount buying opportunity, whereas Americans just see sluggishness and want out.
That's a fascinating cultural divide. And it wasn't just a blanket sell-off in the U.S. either. Even in this risk-off environment, some specific altcoins actually saw money coming in.
Yes, looking at the specifics, while Bitcoin and Ethereum saw outflows, Solana saw $31 million in inflows, and XRP saw over $33.4 million.
That's significant. While the big two are bleeding funds, people are actively buying Solana and XRP.
It suggests investors are becoming stock pickers, so to speak. They aren't just blindly buying crypto anymore. They're placing targeted bets on high-throughput chains like Solana or the specific payments utility of XRP.
Speaking of global differences, let's widen the lens. We mentioned the SEC, but what's happening around the world?
Yeah.
Because the regulatory landscape is shifting fast.
It's a mixed bag globally. In Hong Kong, we saw a very positive signal. The SFC granted the first new crypto platform license since June 2025. It went to Victory FinTech.
And that signals Hong Kong is officially open for business again after a quiet period.
They want to be a hub.
Yeah.
But then you look at Europe, and specifically Poland. The president there vetoed the MiCA implementation bill again.
And just for context, MiCA is the markets in crypto assets regulation. It's the big EU-wide rule book that was supposed to harmonize everything.
Exactly. It's supposed to be the gold standard for clarity. But Poland is the outlier. It's causing massive confusion for local crypto firms there because they don't know what rules apply to them right now.
Closer to home, for our listeners in California, there is a serious deadline looming. We need to do a quick public service announcement here.
Yes, this is urgent. Under the new digital financial assets law, if you operate a crypto business in California, the new licensing deadline is set for July 1st, 2026.
Okay, July 1st.
But, and this is the kicker, companies must apply by March 9th to be eligible. That's barely 2 weeks away.
So if you're a founder in Silicon Valley and you haven't filed yet, you might want to stop listening to this deep dive right now and call your lawyer.
Immediately, get that application in.
Let's look at the week ahead. We have a very busy calendar. Tuesday, February 24th, is the U.S. President Donald Trump's State of the Union address.
Markets will be listening very, very closely to that.
And as a reminder to you listening, we're just looking at this strictly from a market reaction standpoint.
Yeah.
What are analysts listening for specifically?
The market is listening for mentions of tariffs, the dollar, and the debt. If the rhetoric points toward policies that could spike inflation, that hurts the case for rate cuts. And as we established, no rate cuts equals no retail rally.
The market hates uncertainty.
Exactly. We also have key economic data coming out, U.S. factory orders, consumer confidence, and the big one, PCE inflation data later in the week.
And we have Fed speakers lined up too, right? Governors Waller and Bostic.
Yes. Given the division on the 2026 rate path, every word they say regarding those early 2026 cuts will be parsed by algorithms. If they sound hawkish, meaning they want to keep rates higher for longer, expect Bitcoin to test that $65,000 support level again.
So to bring this all together, we are in a strange limbo. The plumbing, thanks to that SEC rule change on stablecoins, is getting a massive upgrade. Wall Street can finally hold stablecoins without a penalty, effectively integrating crypto into the banking system.
Right.
But the water pressure, the actual liquidity and retail interest, is low because the Fed is keeping rates high. Europe is buying the dip, the U.S. is selling the fear, and Bitcoin is basically waiting to decide if it can reclaim $70.
That is the perfect summary. The pipes are bigger, but the tap is turned off for now.
Here is a provocative thought to leave you with. We often talk about crypto democratizing finance. But look at what just happened. The SEC made it easier for Wall Street to use stablecoins. They rolled out the red carpet for the institutions. Meanwhile, high interest rates are keeping the average retail investor on the sidelines because they simply can't afford the cost of capital.
It's an uncomfortable reality of this cycle.
Are we building the next bull run for the people, or are we just building it for the banks?
If the new regulations make it easier for the institutions, but retail capital is priced out, the institutions get the first seat at the table.
It's definitely something to mull over or explore on your own this week as you watch the charts. Keep a close eye on that $68,500 level on Bitcoin. That is the line in the sand right now.
I'll watch it closely.
Thanks for joining us on The Deep Dive. We'll catch you next time.